look at first what happens to inflation and interest rates at the end of a monetary era that we are in right now. Interest rates have gone from 16%, that's measured on the 10-year US Treasury bond. In 1980, there was 16%, and it was down to 0.5% in 2020. Now we're just over 4%. My forecast, as this graph shows, is that we are going to go above the 16% in the 1980s. I think we could overshoot it by a big margin for the simple reason that inflation will be higher than it was in the 1970s, and there'll be many more defaults than we saw in the 1970s. And I would expect in this coming era that we also see sovereign defaults. The US will definitely default in one way or another. Doesn't mean that they go bankrupt, but it means that the currency will go to zero and the money printing will be unlimited. So that virtually will lead to US Treasury bonds being worthless, and therefore interest rates could even go a lot higher than the 16 to 20% that we saw in the 1970s. It could go a lot higher even. Now, of course, people will suffer dramatically with these high interest rates. I saw just a recent article, fishermen in the North Sea. It used to cost them £5,000 to go out with their boat to fish haddock, and now it's up to £10,000. It's doubled in a very short period of time. That means higher prices for consumers, lower income for the fishermen, and losses within the system. And that's just one example. It will happen throughout the system. There'll be massive inflation and there will be misery because people cannot afford the higher prices, and all governments can do is just to print more money and make the currency more worthless than it is now. And it's, as we know, and I talked about many times, already gone down by 99% since 1971. That is against gold, dollar, euro, yen, etc. And they've all gone down 99%, and it's only 1% left. So this will just not have consequences for markets, bond markets. That will, as I said, crash, but also for stock markets. Stock markets are now starting a major downtrend. Before this is over, I see the Dow Jones and the Standard & Poor's go down by 90 to 95% against gold. And gold is really only measuring in real terms. So if you look at the graph here, it shows how we've already gone down 75% since 1999. That is, the stocks or the S&P has gone down 99% versus gold since 99. Now, from this level, I expect another fall of 95% before this era is over. And that fall could happen very quickly. It could take a few years. And then after that, it goes along the bottom, maybe for 5, 10 years or longer. So this is a massive shift from paper assets to real assets. And anyone who gets caught with the paper assets and does not shift into real asset is going to lose all their wealth in coming years. I repeat, you are going to lose all your wealth if you don't shift to real assets. And that is not a joke. That is absolute reality. And please don't wait for the market to recover before you sell. Sell now. Sell before it reaches the low levels. You can never sell at the top. Now is a good time to sell. Now is a good time to switch to gold. Remember, so gold is going to go up substantially, but that is measured in dollars or in euros or in yen. But actually in real terms, gold is not going up. It's never gone up. Gold maintains stable purchasing power. I've looked at the ratio between a cow and gold. You know, since we can't measure gold in money terms because money goes down in value by the day, why not measure it in something real that everybody consumes? That is, for example, a cow. And over the last 5,000 years, a cow in gold terms has cost between around half an ounce of gold to just over 1 ounce of gold. That is quite remarkable. Think about that. Cow has not gone up by more than half an ounce of gold maximum over a 5,000 year period. It shows you that when you look at your wealth in paper money, it's absolutely the wrong measure to use. Think about instead money in real terms. Think about money in gold terms. That's the only way to measure your wealth. So what is the consequence of this? Of course, the consequences are dire. It'll be collapse of the financial system. There'll be a collapse of the many banks, maybe the majority of the banking system. It'll be restructured at a massive cost. There'll be collapse of the bond market and, of course, of the stock market, as I said, and times will be very tough. So in money terms, which, as I said, is not the way you should measure gold. You should just take gold as stable purchasing power. But if you want to look at it in money terms, because you should, because if you keep your money in currencies, in dollars, in sterling, pounds, or in yen, then you're going to lose all of your wealth. But if we measure it in real terms and adjust it for inflation, gold adjusted for real inflation, this is the way that inflation was calculated by the US government in the 1970s. Then, if you adjust it for that, the gold price of 1980, which was $850 at the high in 1980, that gold price today would be $38,000. $38,000. And that is actually not a target, as I said earlier on. That is just coming back to the inflation adjusted level as it was in 1980. And in this coming era now, it could happen very quickly or it could take a few years. We will see at least that price in paper money and probably a lot more because, as I said, there'll be massive amounts of paper printed. So please buy gold, buy physical gold, store it in a safe place, in a safe jurisdiction outside the banking system. Also buy some silver. Silver is now massively undervalued and is likely to go up a lot faster than gold for quite a time. So please look after yourself, look after your family, look after your friends if you can afford it, and own some physical gold and own some physical silver.
Well, as I said, we are now entering the exponential phase of the metals for the simple reason that the world economy, and especially the Western economy, is now collapsing. And so you get this phase at the end when things go a lot faster. Currencies is no use comparing on is the dollar stronger or is the euro stronger or the yen. It doesn't matter. They're all absolutely rubbish. They all go to zero. So therefore, we have to have other ways of looking at gold and silver, of course. And the way we look at it is ounces or kilos or grams, or whatever level you're investing at. So that's the only way to look at it. To measure your wealth every day, if you have gold and silver in dollars, is totally useless. Totally useless. Look at the prices now, right? It's not, people think, and that's because that's what governments tell them. People think that prices are going up. They aren't going up at all. It's the value of the currency. And of course, as you said, why is it going up now? Well, first of all, the money supply has been increasing rapidly for 50 years, let's say, and certainly in this century. And gold hasn't kept pace with that. And that's happening now. And of course, now gold is also forecasting that there will be, in the next 5 years, maybe more, 10 years, unlimited money printing to try to save this world. And sadly, that is going to fail. But that is the consequence of the levels of debt we have now, and the bond market. It's not going to be possible to finance the deficits that we're going to see in the future. And therefore, interest rates will go up dramatically. And interest rates also has to obviously reflect the risk of default. And the risk of default is going to increase by the day, because we will see failures in corporate markets, we'll see failures in government markets, and obviously we will see massive failures in the banking world. And that's why, I said for years that the governments are not going to be, or central banks, to be able to control the currency, the rates, the interest rates. And they will try with the shorter term, but it's going to fail. The market, and led by the longer rates, will just sell off. The bond market will sell off, which means that the interest rates are going to go up and up and up. And I came to the UK in the early 1970s, and I saw inflation during 7-year period being an average about 15%, 15%. I saw my first mortgage in 1973. The interest on that went up to 21%. 21%. How many people today, Kai, can afford a 21% mortgage rate? Nobody. No. And whether we will go to that level or not, I wouldn't be surprised. We will certainly go up in the teens. And of course, so there won't be, people will not have money to pay for the mortgage or pay for the debts or interest on their debt. And that's so the government will have to print unlimited amounts of money to help them. And this is how you get the cycle of higher rates, higher inflation, and collapsing currencies. It's so simple. You know, remember, we decided to go into this 40 years ago to gold. We went in actually in the early 2000s because we waited for the gold to bottom out, and we were lucky to pick it up almost at the bottom. And since then, you know, I've never worried one day. I never had to look at the price of gold. We didn't go into silver heavily or at all, actually, in the beginning. And then we went in a bit when we thought the timing was right. And silver now, of course, I'm sure we'll talk about that, is going to go up faster than gold. But you know, for wealth preservation, gold is the right metal to hold. And you know, gold is still going to go up, in my view, by multiples from here, reflecting all of the problems that we will see in the economy. And as we say, this, I think, you know, gold normally